will come back to help her dad. Today, we're diving into the world of value investing, a strategy focused on identifying and purchasing stocks that are trading below their intrinsic worth. This approach, championed by investment legends like Benjamin Graham and his most famous student, Warren Buffett, centers on the core principle of seeking out undervalued companies in the market. The goal is to find these hidden gems, stocks that the market has temporarily mispriced, and hold them until their true value is recognized. Value investing revolves around a few core principles, the first being margin of safety, which means purchasing assets at a price significantly below your estimation of their intrinsic value. This discount acts as a buffer, protecting you from potential miscalculations in your valuation and shielding you from unexpected negative events. Speaking of intrinsic value, it represents your assessment of a company's true worth, relying on fundamental analysis rather than being swayed by the prevailing market mood. It's worth noting that accurately determining intrinsic value can be challenging. Finally, we have the concept of Mr. Market, a metaphor for the market's inherent volatility and tendency towards irrational behavior. A value investor uses these market swings to their advantage, capitalizing on opportunities when Mr. Market offers securities at bargain prices. Let's talk about how to actually identify undervalued stocks. The primary method is through fundamental analysis, where we meticulously review a company's financial statements, including their balance sheet, income statement, and cash flow statement. It's also important to assess the quality of the company's management team and thoroughly analyze the dynamics of the industry in which they operate. Another key aspect involves examining specific financial ratios, such as the price-to-earnings ratio, the price-to-book ratio, the price-to-sales ratio, and the dividend yield, all of which provide clues about potential undervaluation. Finally, don't forget the importance of qualitative factors. We must consider a company's competitive advantages, often referred to as moats, their brand recognition, and whether they have a sustainable business model for the long term. These qualitative aspects provide a more complete picture of the true value of a company. Let's dive into the value investing process. It typically starts with screening, where you use filters to identify potential investment candidates based on predetermined criteria. These criteria could include things like a low price-to-earnings ratio or a high dividend yield. Once you've identified some potential companies, the next step is due diligence. This involves in-depth research on the shortlisted companies, taking the time to read annual reports, industry analysis, and relevant news articles. After that thorough research, we move on to valuation, where you estimate the intrinsic value of the company using various methods, such as discounted cash flow analysis. Finally, the process ends with portfolio construction, where you build a diversified portfolio to reduce risk, focusing on long-term holdings that represent the best value opportunities you've identified. Let's consider the advantages and disadvantages of value investing. On the plus side, value investing offers the potential for higher returns over the long term, because you are buying assets at a discount. It also provides a lower risk profile, thanks to the margin of safety built into the investment. This approach encourages a disciplined mindset, as you're focused on fundamentals rather than speculation. However, value investing does have its drawbacks. It can be a slow process, demanding patience as you wait for the market to recognize the true value of your investments. Value investing strategies may underperform during bull markets, when growth stocks are soaring. Finally, it requires significant research and analysis to identify undervalued companies and assess their intrinsic value. Here are some examples of successful value investors, starting with Benjamin Graham, the father of value investing, whose seminal work, The Intelligent Investor, is a must-read for anyone interested in this strategy. Then there's Warren Buffett, arguably the most famous value investor of all time, who built Berkshire Hathaway into a global conglomerate using value investing principles. And finally, we have Seth Klarman, who runs the Bopos Group, a very successful, albeit lesser known, value-oriented investment firm. Thanks for watching. See you next time on Helper Dad. So, in conclusion, let's quickly reiterate the key benefits of value investing. It offers the potential for long-term capital appreciation by identifying and investing in undervalued companies. Remember to continue your learning and research into value investing strategies. The more you know, the better equipped you'll be to make informed decisions. Finally, don't hesitate to consider seeking professional advice from a qualified financial advisor to help tailor your investment approach to your specific circumstances and goals.